Thanks again for joining us for this episode. I'm Bill Fairman, and this is
Wendy Sweet.
And
yes, I am.
In this episode, we're going to discuss what to expect as an investor, but it's really more of a description of our fund, how it operates, what it is we invest in, when everything happens. And so, let's just get started off. So this fund makes loans, and they're called hard money loans and bridge loans. So what is a bridge loan? A bridge loan is a loan that is bridging the gap from here to here. In a nutshell, if you're an investor and you're either buying a house to rehab, buying a lot to put a house on, buying a small apartment complex that is distressed, needs to be updated, and they call it stabilized. So let's say it's only 60% occupied. For the area, 85% occupied is capacity. Being stabilized is making sure that it's stabilized, or
stable like a horse.
Yeah. Well, 85% would be stable for the market. So you want to bring it up to 85% occupancy.
Right.
And all of these are going to happen with one or two exit strategies for the borrower, right?
Right.
So you're either going to sell the house
or refinance
or
it.
you're going to refinance it because you're going to rent it out.
Right.
Same thing with a
Anything.
commercial property. You're either going to sell it at a profit because now it makes more money and it's worth more, or you're going to refinance it with a traditional bank because our payments are going to be way too high for you to make any money if you're renting it.
That's right. And we want our money back.
Yes. So that's what we invest in. We typically are only going to invest in our backyard, or we're going to make loans in our backyard.
Right.
Now, our backyard is the southeast. We are located in Rock Hill, South Carolina.
Woo-hoo.
That is a bedroom community of Charlotte, North Carolina.
Go Panthers.
So about 75% of the loans that we do are in the Charlotte market.
Right.
But we do all the states that touch North and South Carolina, plus a couple more. So those are the geographic areas. The types of properties that we do, we mentioned single family, multifamily. We do self-storage. Heck, we even do mobile home parks. But they're all going to be income producing other than the fix and flip properties. Right. So you have a couple of exit strategies with those. We are really more defensive of a fund. And what we mean by that is that we're not chasing yield.
Right.
Our ideal borrower is somebody that has been around a while. Our ideal property type is going to be on the affordable housing side of things.
Very vanilla.
And, affordable housing in different parts of the country are different everywhere. In our market, it's under 300,000 if you're a single family resident. We're looking for that piece of property that is going to be valued by the largest number of possible buyers, if that makes sense.
Want a big target. Yeah, we want a big target.
So in the conventional loan space, the most valued property is the single family residence in a subdivision with 2.5 kids playing in the front yard. And anything outside of that piece of pie gets a little bit more risky. If you get a $12,000 house, how many people want to buy a $12,000 house? Well, most people would say, oh yeah, I'll take that. Do you really want to live there?
Good place for your
Probably not. And at the same time, not too many of us can afford $1 million houses either. So we want to be in that sweet spot where we can sell to a first-time homeowner, someone that's downsizing, a real estate investor, or somebody renting. Believe me, you can't rent $1 million house and get the same return on investment than you can $150,000. Right. So that's the space that we're trying to lend in. We call it defensive and being conservative, because while we're not trying to hit the big home runs, we're trying to stay in that market that worst thing happens, like 2008 and we end up owning all the properties, we can still rent them out for what our expected return is going to be.
Exactly.
So as our fund goes, what happens in our fund? Well, number one, everything happens on the quarters. That means you get paid on the quarters. We close out the quarters. You get into the fund on the quarters. Doesn't mean we won't take your money before that. And we'll get into some detail later on that. But everything happens on the quarters. You get your statements on the quarter. We pay out on the quarter. And then annually we have a meeting with all the members. We typically just do a big Zoom webinar because you can't. We currently have 97 investors. It's hard to get 97 people on the same Zoom call. So we do what's called a Zoom webinar where you can have thousands of people on there, but they have to type in a little chat thing instead of actually having their face on there. And then we contact our investors quite often. Wendy and I will do videos all the time, let folks know what's going on with the industry. We want everybody to be informed as much as possible. I think I mentioned this on another show that we have 3 sets of eyes on our books. The fund, you can invest with an IRA, traditional. You can invest with a Roth IRA. You can invest in cash. You can invest with a trust. You can invest in a solo 401k. Our minimum investment is $50,000, but like I said before, most people put in $100,000. We want to make sure that you're an accredited investor, so we have an onboarding site that will put you through.
Plus,
but we have to interview you first.
Isn't it if your kids, you have children that still live at home under the age of 18? Is it 18?
Yeah, your dependents under 18, you can invest their money because you have the power of attorney. But as soon as they turn 18,
you got to get their money out.
I have to give you back their money, unless you want to donate them enough money so they can be accredited.
Yeah, that's always an option.
I'm sure they would appreciate that. At the same time, we're not going to hold property in that type of a fund. We only make loans in that type of fund. One of the biggest benefits of the fund is that you get the opportunity to compound over time.
Right.
Was it Einstein, or I think Einstein said it? Well, anyway, I think he said it was the 8th wonder of the world, compounded returns.
Yeah.
So let me give you an example. And this is purely number example. If you were making a 10% annual rate of return, at the end of the year, you'd have 10% more than what you put in. If you compound over 10 years, that same 10% annualized return, meaning you're taking that earning every quarter and you're adding it to your balance. At the end of 10 years, you'd be north of 16% return. And you've done nothing more than just allow the balance to grow.
To roll over.
And that is why compounding is the 8th wonder of the world.
That's right.
we love compounded returns.
Yes,
now,
we do.
It's a little bit different on the notes side of things, where you're going to receive payments monthly. In the fund, you're going to get your returns quarterly, whether you take payments or whether you compound it. If you're in a note, you're going to get payments. You cannot compound it. And that's why we tell people, if you're accredited, the best place to put your money is in a fund, because what happens when I pay you monthly payments? What do you do with that money?
I put it in the bank until I have enough money to make another investment, and I have to wait until that happens.
That's
right.
So are those monthly payments earning anything?
No, they're sitting there waiting to be used.
And then the other benefit is, once your money is in the fund, it's always working.
Always working.
When you're in a loan, what happens when it pays off?
It's sitting there waiting to be used again.
That's right. So if, for example, you're making an 11% interest rate on a note, and it takes you, and that note pays off within the year, and it takes you another month
to put it out,
to get it out there in another deal, your actual annualized rate of return is like 9.49%.
Right.
And it only took that 1 month
Yeah.
to drop it from 11 to 9.49. That's pretty much it on the fund. I know there would be a lot of other questions. I want you to go to carolinahardmoney.com and click on the tab that says investor. And that'll give you a little bit more information. And there'll be a little questionnaire there if you want more information on the fund. We got tons of videos on it. There's a way to schedule a free consultation with us to talk about the fund. We want you to read the PPM, the term sheets. What are we doing on our next show, Wendy?
Let's see. Our next show, we're going to be talking about the differences between hard money and bank loans. And that's a great topic because there's
absolutely.
A lot of differences.
Yeah, and why you would need a hard money loan if you can qualify for a bank loan.
Right.
All right, so next show, we're going to discuss more on the borrowing side and the advantages of hard money versus bank. And there's a place for both. Don't get me wrong.
That's right.
And we'll get into that. So for now, it was wonderful having you with us. Don't forget to subscribe, hit the like button, please.
Yes, please.
Scott always tells us that we get paid by the likes. I haven't seen monetary notice that had a like on it.
I see some of them dripping off of there now.
And then again, our website, carolinahardmoney.com. If you're interested in investing, click on the investor tab. Have a great day. So thank you so much for joining us. If you really like what you heard, you want to see some more, switch over here or here or perhaps there. There's more episodes, but they're somewhere.
Yeah. I think
click it on.
They're up.
By the way, subscribe and like us as well.
Please.